Okay, before we get started, I've just been asked to read the following regarding some housekeeping items. We are offering CLE credit to those seeking it for today's session, and we'll read the CLE code aloud when it appears throughout the presentation. The CLE forms have been circulated along with the connection details for this session, and they should be completed and returned to the Mayor Brown email address listed on those documents. Should you have any questions throughout the presentation, feel free to enter them into our chat box and we will do our best to answer. Finally, please note that we will circulate a copy of the materials and a replay of this session in the coming days. With that, let's get started. So welcome. My name is John Berkery. I am a partner in the Corporate and Securities Group here in New York. I'm joined by my colleague, John Ablan, who is also a partner in the Corporate and Securities Group, and he's based in Chicago. Today's session is liability management. It's part one. Part two will be given tomorrow. It has to deal with aspects such as tax ramifications of liability management transactions and other elements. Let's go to the next slide. For today's session, we're going to be starting off with an overview of liability management, discussing what it is and what its benefits are. And then we're going to go through each of the different types of liability management transactions, including redemptions, repurchases, debt tender offers, exchange offers, and consent solicitations. Next slide, please. And one more. So what is liability management? It's a term simply that refers to a variety of transactions that are designed to assist an issuer in managing, modifying, and optimizing its outstanding debt portfolio. And it does that by achieving at least one of three goals that are set forth here in the Olympic rings here to the right: to retire debt, to refinance debt, and or to modify debt. Now, a liability management transaction may achieve all three of them, but every liability management transaction will achieve at least one of them. And within each of the rings here, you have the different liability management transactions and the goals that they attain. So if you're talking about retiring debt, you will be considering redemptions, repurchases, and tender offers. If you want to refinance debt, you'll be thinking about exchange offers or a tender offer with a concurrent new debt financing. And if you want to modify your outstanding debt, you'll be contemplating consent solicitations. Let's go to the next slide. So why is liability management important? Simple answer is it is important because of the benefits that companies obtain through it. One of the most common benefits is deleveraging, or reducing the outstanding debt portfolio of the issuer, which can always be a good thing. Reducing interest rates, which can be accomplished as a result of reducing the size of the debt portfolio, or because of changes in interest rates, exchanging high coupon debt for low coupon debt. An issuer may want to capture positive economics because of its operations and its financial condition. It may be awash with cash, and a good use for that cash may be to reduce debt. Alternatively, an issuer may see its stock price rise, very well in the market, and either through securities offerings where it uses that cash to take out debt, or through doing an equity for debt exchange offer, it can enter into liability management transactions. Another benefit is possibly extending maturities. A company may have debt coming due in the near future, and liability management transactions can push that debt out in the future, as well as spread it out over a number of years if the debt happens to be maturing all at once in one or a few number of years. If you are taking out debt at a discount, you can record an accounting gain, which will have an improvement, obviously, on the income statement, but all of the features above in terms of reducing your debt, reducing interest expense, all of that can have a positive impact on your financial statements, from the balance sheet through the cash flow statement to the income statement. And all of this in turn can have could have a very positive effect on your ratings. So issuers are always encouraged to be communicating with the rating agencies to make sure they're structuring it properly to receive the maximum ratings benefit to the extent they can. If you are a regulated entity, liability management transactions can help with respect to your regulatory capital. If you are modifying the covenant package or the terms of the outstanding debt, you can achieve additional flexibility, both financial, operational, or maybe for a particular transaction. But overall, liability management transactions are designed to help an issuer proactively deal with its capital structure and deal with debt holders from a position of strength where you have the most options. Rather than waiting around till it gets too late, you may be in a distressed position, you have fewer options, and at that point in time, your only alternative may be a fundamental restructuring or a potential bankruptcy. Next slide, please. So how do we affect liability management transactions? Well, if the issuer has cash, some of your options are redemptions, which is simply the contractual right of the issuer to repay and retire its outstanding debt securities in accordance with its terms. Repurchases, which is simply a voluntary transaction between the issuer and the holders of its outstanding debt securities to repurchase them, whether in open market transactions or in privately negotiated transactions. Or tender offers, which is another voluntary transaction. It is an offer by the issuer to the holders of its outstanding debt securities of the whole series, offering them to repurchase them at a certain price for cash. Next one, please. Your non-cash liability management transaction alternatives include exchange offers, where you are offering a new series of debt securities for the outstanding debt. Now, in most securities offerings, the issuer is issuing the debt securities and in return receiving cash. These ones are a little different. The only consideration generally that the issuer is receiving is its own outstanding debt securities. But nonetheless, exchange offers are securities offerings, and therefore you need to make sure that the offering itself is compliant with the 33 Act, which means your exchange offer must be either registered under the 33 Act or done pursuant to a valid exemption therefrom. So very often exchange offers are done on a private basis pursuant to 4A2, or another exemption is Section 3A9, which my colleague John will get to in a little while. Or as I said, they're done pursuant to an effective registration statement. The other non-cash alternative is simply consent solicitations, where you're asking debt holders to give their consent to modify the indenture or the other debt agreement that governs the debt securities. It's not exactly 100% non-cash, because generally there is a consent fee, and that consent fee is generally paid in cash. But in the proportion of things, it's generally a small amount. So that's why it's under non-cash alternatives. Next slide, please. So how do you choose amongst the different alternatives of liability management transactions? Well, most important, obviously, is what are the objectives the issuer is trying to achieve? Is the issuer trying to delever? If so, you're probably talking about redemptions, repurchases, or cash tender offers. Is the issuer not necessarily trying to delever, but to extend maturities and reduce interest expense? If so, then you're probably talking about exchange offers, or it could be a tender offer coupled with a concurrent new debt financing. Is the issuer trying to achieve covenant flexibility? If so, then you are absolutely talking about consent solicitation, but that can be done either on its own, or possibly it could be coupled with an exchange offer or a tender offer. To another extent, it'll be based upon the issuer's financial condition. As we said, there are certain transactions where you need cash, and if the cash is limited at the issuer or doesn't have any available, certain options are not going to be available to you. Other things you want to take into consideration are the legal considerations. From a legal perspective, which ones are going to, how difficult are they going to be to execute in terms of time and expense? Other things you want to be mindful of are accounting ramifications and tax considerations of each liability management transaction. As I said before, you want to be communicating with rating agencies to see what ratings benefit you will be achieving. If you are a regulated entity, you want to be speaking with regulators to make sure that this is compliant with their requirements and see what improvements you can be making in your regulatory capital structure. All of these things need to be factored in. Next slide, please. Thinking ahead, This is one sort of obvious. And just don't be focused on your transaction at hand, but looking at the issuer's other agreements, particularly its debt agreements, to make sure the transaction you want to undertake is not going to be prohibited or otherwise violating that debt agreement. Very often, if you're taking out subordinated debt, whether it's expressly subordinated or it is effectively subordinated because it doesn't have the benefit of a pledge of collateral or subsidiary guarantees, which other senior debt of the issuer may have, quite often that other senior debt is going to limit the issuer from using cash to take out debt which is either expressly or effectively junior to that senior debt. Even if it's pari passu, very often other senior debt will say, it's fine if you want to take out or reduce other senior debt, but if you do, you have to equally and ratably pay us back. There may be provisions in other debt instruments which say if you do issue debt, you have to use those proceeds for particular purposes, which may not be in line with the purpose you have in the liability management transaction. And then obviously you want to, if you are issuing new debt, you want to look at the terms of that debt, whether it's secured, whether it has the benefit of subsidiary guarantees, even covenants. You have to check on whether any of those terms or features are restricted by the issuer's other debt agreements. So just keep that in mind. Next slide, please. So let's talk about the first type of liability management transaction, which is redemptions, which is the contractual right of the issuer to repay and retire its outstanding debt securities in accordance with its terms. Now, that's going to happen if an issuer elects to redeem its outstanding securities pursuant to optional redemption. That is going to happen regardless of whether or not the holders of those debt securities want it to happen. It's a contractual right. On the scale of liability management transactions, redemptions are probably the most easy to effect because they're generally just that the procedures are laid out in the indenture and they're pretty easy. On the other hand, in terms of cost, they can be on the other end of the spectrum in terms of higher cost because the redemption price can be quite expensive, particularly if you're trying to redeem the securities in their early years. In other words, in the first few years after issuance. Okay. So how do you effect a redemption? Well, you just follow the contract, the indenture, and it'll specify the procedures, which generally entails issuing a notice of redemption, generally through the trustee. Doesn't have to be though. And it has to be issued for a certain period, generally not more than 60 and not less than 30, although sometimes it's as little as 10 to 15 days recently. And that notice has to include other important information, which is quite frankly pretty obvious. And we want to set forth what the redemption date is, what the redemption price is. Are you redeeming all of the debt securities of the series, or is it a partial redemption? If it's a partial redemption, how are you selecting the securities that are going to be redeemed? And also whether or not the redemption is subject to any conditions precedent. For instance, you may have a redemption set on a date, but it's subject to the company affecting another financing that'll provide the funds that'll use to pay the redemption price. And if that financing is not consummated by the time of the redemption date, the issuer either has the option to terminate the redemption or to extend the redemption date. Next slide, please. So redemption price. Generally, two basic types. For investment grade securities, it's generally called a make call. And what it is essentially the present value of all remaining interest and principal payments that remain on those notes through and including the par call date. So you look at all of those interest payments and the amount that is going to be due and payable on the par call date, and you take the present value of those amounts and add them together. You determine the present value amount by discounting it based on the effective yield on the outstanding U.S. security that has a maturity closest to the par call date or the maturity date of the securities you're redeeming. And that you generally add to that yield a spread, which is a payment, a payment term that gets done at pricing. It's generally 50 basis points, but it can be lower. I've seen it as low as 30 basis points. And that's how you calculate the make-whole redemption price. It's called a make-whole because it's quite expensive, but it's called make-whole because in theory, the note holders are supposed to be able to take that amount that they receive, the make-whole redemption price they receive, go out and buy treasury securities, and they should be effectively made whole. In other words, the returns on those securities, if you hold them to maturity, should effectively put you in the same price as if the securities were never redeemed. At least theoretically, that's why they call it make-whole redemption. For high yield debt securities, it's generally pretty different. They're generally redeemed at a fixed price after a non-call period. So let's take an example. Let's say you have a 10-year high yield debt security, which has a coupon of 8%. Now, most high yield debt securities have a non-call period, which is roughly half the maturity date generally. So for a 10-year a bond, you'd have a non-call period of 5 years, which means you can't call it the first 5 years, but in year 5, you are able to redeem it at a fixed redemption price. And that redemption price is generally half the coupon. So if our coupon or our interest rate was 8%, then the redemption premium is 4%, meaning the redemption price is 104% of the principal amount of bonds you're redeeming plus accrued and unpaid interest. And that redemption premium reduces annually each year pro rata to par 1 or 2 years out prior to maturity. One little thing there, I know I called it the non-call period, and that's the period where you're not being an issuer doesn't have the right to redeem the securities. So if a security has a non-call 5, as I said before, you can't call it during that period. Very often, because it's so expensive, there is a provision which allows the issuer to redeem the notes during the non-call period, but it's at the make call. And even though even though you have the right to redeem them with the make call, because it's so expensive, people generally never consider that it will be used, but they're still called non-call 5 securities, so to speak. Let's go to the next slide. Other considerations, again, like we were discussing before, check your other debt instruments to make sure the redemption is not going to be prohibited. Especially, this is one that many issuers trip accidentally when they are redeeming their outstanding debt securities. You have to worry about a potential violation of selective disclosure of material non-public information pursuant to Regulation FD. And the reason is because the redemption itself may be a material event, not only to the holders of the debt securities that are being redeemed, but also possibly to the holders of the issuer's other securities, including other debt securities or maybe even the common stock. It depends upon the financial condition of the issuer, the size of the redemption. But if there's any possibility that redemption event in and of itself could be a material event to that issuer, then what you want to do is make sure you issue a press release at that time so the market knows. Because if you simply follow the procedures in the indenture, then that means you're only going to issue the notice of redemption through the trustee to the holders of the notes. And as that goes through DTC and gets winded down through the direct participants and the indirect participants, and ultimately to the beneficial holders, one, it's going to take a lot of time. Two, not all the holders are going to see it. And so if it is a material event, only very few numbers of security holders are going to see that. And that's selective disclosure, what Reg FD was designed to prevent. So again, it's generally good practice when you do a notice of redemption to issue a press release announcing that redemption. And if the company is an SEC reporting company, to also file a Form 8K with the redemption announcement as well. Next slide, please. Okay, so we're going to talk about debt repurchases now, and I'm going to hand it over to John.
Great, thanks, John. So again, for everyone, I'm John Ablan. I'm a partner in our capital markets group here at Mayer Brown, sitting in our Chicago office. I'm going to be talking now about the second type of liability management transaction in our series here, which is debt repurchases. And moving along our continuum of possible liability, management transactions, right? This one has the benefit of being much cheaper than a redemption. No make whole is payable. It also is relatively simple, as we'll talk about with the documentation, but a disadvantage as compared to redemptions and some other types of liability management transactions is that it really can be used only for a limited amount of debt security of any particular class. So let's get into it. What are we talking about here? So a debt repurchase is what it sounds like, right? The issuer is going into the market and repurchasing its own debt securities, typically at or around the market price that it's being traded at anyway. That happens in a few different ways, right? Sometimes it can happen with a reverse inquiry where a holder of bonds can call an issuer up and say, look, would you be interested in purchasing my debt? And that negotiation can happen between those two parties directly. Sometimes an issuer will proactively seek to purchase debt in the markets. It will engage a financial intermediary, typically an investment bank, to act as its agent and be a repurchase agent and purchase a limited number of debt securities. Other times, a financial intermediary, investment banks, they can take positions in an issuer's securities and kind of fall back into prong one, where they can do a reverse inquiry basis. They can either on their own behalf or on behalf of some of their customers approach the issuer about repurchasing a portion of the debt. Let's go to the next slide. So what are the benefits, right? Obviously, because you're buying it at the market price, typically, you can take advantage of fluctuating market prices, right? If there's a movement in the debt that you think the debt is underpriced, and you want to take advantage of that, is your ability to repurchase the debt. Repurchase $1,000 worth of bonds, at a price of $900. You only have to pay a discount. You can take advantage of that. You retire more debt than the cash required to buy it. It can be quick. It can be there's not a lot of documentation that's required for an open market repurchase. Typically it can be handled through brokers and through DTC, and there's very little preparation that's required. And again, when it's most effective when a issuer wants to acquire a small percentage of its debt securities, and we'll get into the reason as to why that is in a moment. Next slide, please. So, John, you might say, why do I have to make sure that it's a small percentage of the debt securities? Why can't I just do my open market debt repurchases for a large amount? Well, the answer is that the Securities Exchange Act contains provisions, and the SEC has implemented regulations that restrict the ability of an issuer to conduct a tender offer, quote unquote, without complying with certain rules. And boy, wouldn't it be nice if there was a definition of what tender offer was, right? When Congress or the SEC was making up all these rules, but they didn't include that, did they? They wanted to make it challenging, so there is no definition of a tender offer. But we all know we have to avoid them or follow the rules. So without a definition, right, courts have, the federal courts have been forced to, when in the context of litigation, fashion their own, definition of what a tender offer is. And so the most common, authoritative statement, test for whether something is a tender offer is something that's called the Wellman test, which, came out of a case involving someone named Wellman. And there's 8 factors to what constitutes a tender offer. None of them is dispositive. If you have one, there's no one that if you have it you are, and there's no one that if you don't have it you aren't. It's a facts and circumstances judgment call. Think about all the situation and factors and talk it over, and get some advice from your favorite law firm perhaps. These are the 8 factors, right? So, is the solicitation, active and widespread, right? Are we talking to a large amount of numbers of shareholders or debt holders, or is it like I described a moment ago, where it's a reverse inquiry, it's a few people, or it's a small amount? What's the percentage of an issue, of the class that's being sought, right? One of the questions in the chat, asked, is there a rule of thumb for this? And they named a dollar amount. I would say it's more, dollar amount is certainly relevant, and the size overall is certainly relevant. But I also think it's a matter of the percentage of the class that you're seeking, and particularly how much of that class will be left over, and how liquid will the market be after you conducted your repurchase. That's a relevant factor here. Is the offer being made at a premium, right? Are you going into the market and you're acting like any other buyer or seller and just taking the market price, or are you looking to buy at a premium? If you're buying at a premium, right, the SEC starts to think, why are you only offering a premium to one holder, right? Certainly under the equity tender rules, a tender offer is required to be put forward to all investors. Are the terms flexible? Are they negotiable? Are you having a dialogue with an individual holder, or are you saying, like, this is our offer, take it or leave it? Is the offer made over a short period of time, right? Are you saying, look, here's our offer, take it or leave it, you have 24 hours to respond, right? That puts a lot of pressure on a potential security holder, and the SEC's rules are designed, to avoid manipulative, deceptive, or pressure tactics that issuers can put on, can sometimes put it on, on security holders. So if you're doing things that are, short period of time, and take it or leave it, that's what the SEC said. Well, wait a minute, maybe we should have the tender offer rules apply here, and have a minimum amount of period, time where the offer is open, and apply to everyone, and that sort of thing. So these are the sorts of things. Is there a public announcement? Is there other pressure tactics? These are the 8 factors. As you can tell, it's a very and sorry, Joe, you were say something?
I was. Your microphone is coming, maybe it's my speakers, but I'm not hearing you too well. It's very grainy. Melissa, I'm not sure if you heard that as well. Maybe come closer to the mic. I'm not sure.
Sure.
That's better, actually.
That better? Okay.
Yep.
Sorry about that. Sorry about that, John.
In the beginning, it was fine. For some reason, it just kicked over to that. I don't know why.
Fair enough. Thank you for saying that. Let's go to the next slide. So, avoiding the tender offer rules, right? If you do want to do debt repurchases, here are some principles to remember, right? Where you want to do it in a manner that's not going to trigger the tender offer rules, right? Limited amount of securities, limited number of holders, no pressure tactics, prices that are individually negotiated. And I should have mentioned this one also, is that typically the offers should not be contingent on each other. That one acceptance in one should not be conditioned on a minimum amount of securities tendered, or a minimum amount acquired, or acceptances on the other. So those are some principles. Again, it is facts and circumstances based. There is no rule of thumb. You have to evaluate each situation. Let's go to the next slide. Other things to think about in the debt repurchase scenario, right? If you are the issuer, right? Basic securities law 101, right? You are conducting a securities transaction. You are buying a security in the market. You need to be cognizant of whether you, as the issuer, are aware of material non-public information, right? If you have more information, you have MNPI, you are at a strategic advantage, as compared with, your security holder. And so making sure that you disclosed your MNPI prior to, making doing your transaction is critical to making sure that you're not going off sides of the securities laws. As John mentioned in his portion, right? If you are going to be cognizant of that, and you're disclosing MNPI, saying, look, I'll disclose my MNPI and tell the security holder about what's going on before we do our transaction. You need to think about Regulation FD, right? If you are a public company and subject to Reg FD, and you're disclosing material non-public information to one of your security holders, you need to think about either doing a Reg FD compliant, public disclosure of that information, or finding another exception to the Reg FD disclosure requirement. Obviously, one exception is if you can get the security holder to agree to lock themselves up, right, and not either disclose the information or trade publicly in the market until the whatever MNPI you have given them has been made public. So let's go to the next slide, please. Thank you. Okay, so tender offers. So we're moving now away from redemptions and open market repurchases into what I would say is the main sort of tool that people think of, the main transaction type that people think of with liability management transactions, which is tender offers. So if you can't structure, if your objectives are to repurchase a lot of your debt, right, more than just a small percentage, and you think to yourself, look, I can't avoid the tender offer rules, no problem. Here we go. Let's do a tender offer. So a tender offer is just when an issuer makes an offer to purchase for a large amount of its securities or on a wide basis, right? Tender offers can be for can range from any and all. Where I will take they announce a price and or a formula to calculate a price, and we'll say we'll take any and all of the securities that are in. Or an issuer can provide a cap and say, look, I only want to retire X amount of my debt. Here's the price I'm willing to pay. The issuer can tender for multiple series of its own debt securities and have a waterfall tender and say, look, I'll tender for any and all of each series, but the overall amount I want to accept for the whole set of transactions is some cap. And I'm only going to, keep going down the waterfall if I still have room under that cap to keep purchasing securities. Issuers can also engage in a Dutch auction tender offer, where typically a smaller percentage of debt is sought, and the issuer says, look, I will establish a range of possible prices that I would be willing to purchase the debt securities at. And as someone tenders in their security, they select what price they would be willing to accept. And then it establishes kind of an informal book building where the issuer can see how many people are willing to sell their securities at a certain price, how many more if they notch it up a quarter of a point, how many more, and they can create a situation where they can decide, what price at which they will accept the various amounts of securities at, how much, the amount of securities that will be repurchased will be dependent on what price ends up clearing the market as a whole for the auction. As you can see, also there's a continuum here on the amount of securities that would be retired in any of these structures. Typically, obviously, if you're looking to retire more, right, you're going to want to be doing an any and all tender or a waterfall. If you want to, have more price sensitivity and create some price tension in the Dutch auction scenario, you're going to want to tender for a smaller amount, right? Because the smaller amount is going to allow you to, more of an ability to purchase the debt at a lower price. And obviously, at the way other end of the spectrum, right, is the make whole redemption, which, as John said, right, is compulsory, right? Everyone has to redeem, everyone has to give you back their debt, but it is very expensive. Let's go to the next slide, please. Thank you. All right, so benefits, right? These answer kind of a lot of the drawbacks of what we've already been talking about, right? So unlike a debt repurchase, you can purchase the whole class, right? You have no limit on the number of securities you can seek in a tender offer. Typically in a tender offer, right, you're pricing this at least at a discount to the make whole, right? If you weren't doing that, there'd be no reason to do a tender offer. You just do a redemption, right? So you're pricing it, somewhere below the make whole, which obviously has benefits for the issuer. As I said, you can not only accept offers, but you can also reach out to all, the entire investor base and try and get as many people to tender in as you can. And there's nothing to stop you from combining a tender offer with a new issue, deal at the same time or shortly thereafter, right, to finance it. And in fact, a tender offer can include among its conditions precedent, a condition that says, look, we won't do the tender offer at all unless we're able to price a new financing, whether that be a debt securities offering, new credit facility or other financing. Tender offers, as John will talk about, can also be combined with exit consents, right? You can combine a consent solicitation with a tender offer and ask people as they tender in and condition their tender in, their tender on their consenting to your proposed amendments to the indenture. Sometimes what issuers will do is they will, in order to provide an inducement to folks to tender in, will say, look, as part of the tender offer, I'm asking you to consent to strip out all the covenants, all the, the main restrictive covenants in our debt securities. Typically, that can be done with the majority of the class. It doesn't require 100%. So investors sometimes sort of say to themselves, wow, man, I maybe should tender in, because if I don't, and 50% do and strip all the covenants, now all of a sudden my debt security looks less valuable because the covenants are stripped, it's a little bit more risky, and maybe it will trade down in the market, both from a combination of having fewer, just securities generally trading in the class, and also from the increased riskiness of the bond. So that can be a powerful tool to induce, folks, especially in a high yield debt security, to tender in. Let's keep going. So how do we do a tender offer? Well, we're going to start, with the, I would say, the most complicated form of a tender offer, which is tender offers for convertible debt. And the reason that it's the most complicated is that the SEC created different rules when an issuer was tendering for equity that's registered with the SEC, as opposed to debt. That the SEC felt that Congress and the SEC determined that as a policy matter, investors needed and deserved more protections than they did in a debt security context. So a piece of convertible debt, right, which is essentially a debt security combined with a warrant to purchase, an out of the money warrant to purchase equity. The SEC says, yeah, it's kind of debt, it's kind of equity, so we're going to apply all of it. We're going to call this, if you're tendering for a security that is convertible into equity, you need to follow the equity tender offer rules. So what are those rules? I mean, the most significant of which is that an issuer must file, make a filing with the SEC called a Schedule TO. And that Schedule TO is potentially subject to SEC review and comment, which can slow down, obviously, an issuer's ability to make a tender offer quickly. The offer has to be made to all holders, right? You can't just make it on a subset, right? So that, think about back to our debt repurchase area. So we got to think carefully about whether we're in a tender offer there, because obviously we would not be making the offer to all holders if it's an equity security or convertible debt. The best price rule, right? Consideration paid to any holder of the securities that are subject to the tender offer has to be the same. It has to, no one can be given a higher price than any other. There's some, ministerial, I would say, requirements for announcement and making sure that the tender offer is well marketed and publicized so people know that there's one going on. The tender offer has to have withdrawal rights during the whole period, which in a debt tender offer, typically withdrawal rights would end, during the offer, period. Even though the offer is outstanding, people would lose their ability to withdraw tender once tendered in. Can't do that in an equity tender. And there's limits on the rule on the issuer's ability to make purchases other than through the tender offer, right? Which is beyond the scope of this presentation, but that's been something that the SEC has been very, it's been attuned to in the SPAC market when they're doing a redemption for their equity securities. The SEC has been curious about how some issuers have been doing open market repurchases of the same equity securities in the market at the same time they're doing a redemption. Anyway, beyond the scope, but that is where that skepticism comes from the SEC. It's from the equity tender rules. Let's go to the next slide. So when you're thinking about these rules, thinking about the things that you got to watch out for, right? Normally in a debt tender offer, right, it's possible to sweeten the tender offer if you say, look, if you tender in your debt securities in the first 10 days of the offer, typically you get a little extra payment for doing that early. Can't do that in an equity tender offer. You would be violating the best price rule. Accounting implications. This one, look, as I said before, a piece of convertible debt is really two securities combined in one. And so there is some care that the accountant has to take as to how a repurchase of a convertible debt is accounted for, because you have to allocate the purchase price as between the debt security and the warrant that I talked to you about a moment ago. So that's a something to just be aware of and make sure that the accountants are attuned to. Typically, convertible debt is often issued at the same time with call spread agreements or other derivative securities. When you're doing a tender offer for convertible debt, you just want to make sure that you're taking care to unwind, or make any adjustments to any of your derivative security after you know how much is going to be purchased. Next slide, please. All right, so moving away from convertible debt into tender offers for straight debt securities, we're in, there are obviously some rules apply, that are applicable, but many of the rules I just spoke about do not apply. Tender offers for straight debt securities are subject to Regulation 14E, and this is Rule 14E1, 14E2, and 14E3. 14E1 is really the main rule that people seem to focus on with debt tender offers. This is where we get the requirement that a tender offer must be held open for 20 business days, and it has to be extended for 10 business days if there's an increase or a decrease in the amount of securities sought or the consideration offered or the DM's fee. There is a minor exception if you want to increase the amount sought by less than 2%. You don't have to do an extension. Any extension must be announced by press release the day after the scheduled expiration. There's other sorts of rules associated with prompt payment, and this is the main sort of requirement when people say like, oh, it takes a long time to do a debt tender offer. Well, this is why, right? The 20 business day requirement as the base case can be a long time. Obviously, as before, the issuer can approach all the holders of its debt securities. And a big advantage over the equity tender rules is that a debt tender offer does not require a filing with the SEC that is subject to review. Again, as John mentioned, a tender offer, the fact that a tender offer is ongoing can be material information. So an issuer may, decide that it's appropriate to make an 8K filing with the announcement, just so people know from an FD perspective, but there is no scheduled TO. The offer to purchase is not required to be filed with the SEC, which is a big advantage and obviously speeds up the time, before launch. Next slide, please. So in the past, the SEC has taken a different regulatory approach to investment grade debt securities that are subject to a tender offer versus non-investment grade or high yield debt. In a series of no action letters, and there's dozens of these things at various for various pieces of this. The SEC basically established an exception, granted for investment grade debt securities subject to a tender offer, that wherein they can either be, the tender offer can be held for a shorter amount of time, shorter than the 20 business days, and the extension can be for a shorter amount of time, and the price at which a security is, the consideration offered for a debt, a debt security. Can be established during the offer, subject to certain conditions. So let's keep going. So when you're doing these structures, typically what counsel is required or does do is cobble together sort of staff SEC guidance to make sure that the objectives of the company that are sought to be obtained can be done under the structure that the company wants, right? And typically it's taking a principle from one no action letter and another and another and another and another, and trying to make sure that the tender offer overall complies with the not only the 14E1 but also as interpreted, or as as the guidance has been enunciated from the staff in various no action letters. This partially changed in 2015 when the SEC issued the abbreviated tender offer no action letter, which, I would call it a sea change in the way that these things were done, which created a uniform sort of set of rules that allowed abbreviated tender offers to take place for both investment grade and non-investment grade securities, assuming all the conditions were satisfied. As John will talk about, those conditions can be preventative in a lot of different situations from the use of the tender offer no action letter. So it's still important to know what the history was beforehand, because to the extent that you can't fit into the 2015 no action letter, you can go back to the previous ones and still try to cobble it together. So let's go to the next slide. So again, back to, non-convertible investment grade debt, there is a line of no action letters that allows an issuer to do a tender offer shorter than 10 and 20 business days, right? Typically it can be as short as 10 or even 7 calendar days if the following are true, right? If the offer is made for any and all debt, all securities of the class to all holders, there's procedures that the issuer undertakes to make sure that the offering materials are disseminated, widely and on an expedited basis, so people know that there is a tender offer, and that there's sort of this, calm waters concept where there's the issuer is not, having a major other event going on with it, right? There's another tender offer, being made on the same securities, right? The SEC wants there to be enough time for people to consider all the offers. Let's keep going. The other item that the SEC has provided flexibility on for investment grade debt is fixed spread pricing, right? The SEC has been convinced and basically recognizes that investment grade debt securities are traded typically on a credit spread to a treasury security of similar maturity. And so it's really that spread to the treasury security, which treasury securities fluctuates every day. It's the credit spread that people are really trading on. And so there's this line of no action letters where people basically say, look, can I set the spread at the beginning of the offer, right? And and at the same time, I can spot the treasury, right, closer to the time at which the securities will actually be delivered. And the SEC has basically said, yes, you can do that. And there's various iterations of, and structures for how the treasury security is spotted. The treasury security can be spotted at day 10. The treasury security can be spotted each day during the tender offer. And if we go actually to the next slide, there is a concept of real-time fixed spread pricing, where you have fixed spread again at the beginning, but then the treasury security is actually, the consideration a debt, tender offer recipient receives is based on price, spotting the treasury on a real-time basis as folks tender in their securities. And these are the requirements to sort of do that. And obviously, having what the treasury, you need to state what the treasury security is, provide some examples, some hypothetical examples of if the treasury security were to be X, your consideration would be Y, and indicate a way for people to make sure that they're able to look up what at any time the trading price is of the benchmark security. Let's keep going. So to sum up, investment grade debt and non-investment grade debt before the world of the 2015 no action letter, right? Investment grade debt, as I said, if you follow the conditions, can be held open for a short amount of time, 7 to 10 calendar days, and the extension can need only be for 5 calendar days instead of 10 business days. But obviously there are strings attached. And in either case, and then for non-investment grade debt, obviously it still has to remain open for 20 business days, and having the extension for 10 business days if you're modifying the consideration sought or consideration offers of the percentage sought. But you are able to use fixed spread pricing in a debt tender offer, even if it's not investment grade. So let's keep going. I think, John, we're passing it back to you for an in-depth discussion on the abbreviated tender offer rules.
Sure. So the SEC's abbreviated tender offer, no action letter, came out in January of 2015. And it was very beneficial to companies because it allowed companies to conduct a tender offer or exchange offer for as little as 5 business days. The other nice feature about this no action letter is, like, unlike in the past, it applied to any type of non-convertible debt security. As John was talking about, almost all of the no action letter relief that came with respect to liability management transactions related, I wouldn't say 100%, but pretty close to exclusively to investment grade debt securities. But this no action letter applies again to, regardless of the rating, as long as it's non-convertible debt, any debt securities. Next slide, please. So in order to avail oneself of the abbreviated tender offer process, you have to meet certain conditions, which are set forth here on page 36, and we'll just walk through them real quickly. First, the offer must be made for any and all of the securities of a class or series, so no partial tender offers. The offer must be made by the issuer or its wholly owned subsidiary or the parent of the issuer, so no third-party tender offers. Next, the consideration in the tender offer must consist solely of cash, qualified debt securities, or a combination of both. What is qualified debt securities? Well, they're essentially securities that are identical in all respects to the securities that you're targeting in the tender offer in terms of obligors, collateral, lien priority, covenants, and almost all other terms except pricing terms, which would include things like interest rate, maturity date, redemption price, non-call period, those type of things, the items that are generally determined at pricing. Otherwise, the terms have to be identical. Secondly, the interest has to be cash payable under the securities you're offering as consideration in the qualified debt securities. So in other words, there can't be any pay in kind, PIK interest. And then lastly, the qualified debt securities have to have a weighted average life to maturity that is longer than that of the targeted debt securities. Next, the offer cannot be financed with the proceeds of debt that is senior to the targeted debt securities. So if you have debt that is expressly subordinated debt, and that's the target of your tender offer, you cannot finance that with the proceeds of a senior debt offering or a senior debt facility. Also, if you have securities, senior securities that do not have the benefit of any liens or collateral securing them, or they don't have the benefit of any subsidiary guarantees, okay, then that tender offer for those securities cannot be financed with the proceeds of any debt facility that does have the benefit of collateral or subsidiary guarantees. Next, the offer must be open to all record and beneficial holders of the targeted debt securities. There's one exception to that. If you are doing an exchange offer, meaning you're offering qualified debt securities, and that is an unregistered exchange offer made to qualified institutional buyers as defined under Rule 144A, or made to non-US persons within the meaning of Regulation S, then that offer will still qualify as long as the holders of the debt securities who do not qualify as qualified institutional buyers or non-US persons have the ability to tender their securities, but instead of receiving qualified debt securities, they'll receive cash in an amount equal to the approximate value of the qualified debt securities that are being offered in the exchange offer. Next, the tender offer must be announced. Oh, I'm sorry, not next page. The tender offer has to be announced by no later than 10 a.m. Eastern time on the first day of the 5 business day period. This is drastically different than how tender offers are effectuated under 14E or any of the no action letters. With those, you are allowed to announce and commence the tender offer at any time during the day. You could commence the tender offer at 11:59 p.m. with 1 minute left in the day, and that would still count as the first day of your 20-day business period for a 14E1 or your 7 or 10-day period if you're doing it under one of the investment grade no action letters, but not for the abbreviated tender offer. That must be announced by 10 a.m. Eastern time by a widely disseminated press release. And if the issuer is a reporting company, that information must also be filed on Form 8K. And then finally, the tender offer must permit tenders through guaranteed delivery procedures. It must provide for withdrawal rights, and the tender offer cannot include any early settlement features. Next slide, please. So like the other tender offers, if you have a material change to the tender offer, then you must extend. But with the abbreviated tender offer provisions, the extension can be much shorter. If you have a change to the consideration that is being offered, then you must extend by at least 5 business days from the date that you make that announcement. If you're making any other material change to the terms of the tender offer, then it must be extended by no less than 3 business days from the time of the announcement. And that announcement must be made by a widely disseminated press release. And if you're an SEC reporting company, you must also file a Form 8K. Next, please. So in addition to conditions to meet to avail yourself of the abbreviated tender offer process, there are also disqualifying events where the abbreviated tender offer process will not be available. And they're set forth here on page 38. So one of them is the tender offer or exchange offer cannot be made in connection with a concurrent consent solicitation to amend the documents of the targeted securities. So if you want to modify the terms of the targeted debt securities, you're not doing an abbreviated tender offer. You got to use the other provisions. The issuer cannot be in default, or there can't be a default or an event of default, not only under the targeted debt securities, but any of the issuer's other material debt agreements. The issuer cannot otherwise be in distress, meaning it can't be subject to bankruptcy or insolvency proceedings, and it cannot have commenced an out-of-court restructuring or other type of prepackaged bankruptcy process. The offer cannot be made in anticipation of, or in response to, or concurrently with a significant corporate event, such as a change of control, a merger, a material acquisition or disposition, and it can't be made in anticipation of a competing tender offer. And then finally, it cannot be made with a concurrent tender offer for other series of the issuer's securities that have the effect of making a change in the capital structure of the issuer, meaning the addition of obligors or collateral or increased priority of liens or shortened weighted average life to maturity of such other debt securities. Next slide, please. So there's a lot of information on this slide, but the point of it really is because of the conditions that you have to satisfy or the disqualifying events, by no means is the abbreviated tender offer or exchange offer provisions the main game in town. It did not replace the other ones because there are many instances where companies may want to or may need to still rely upon 14E1, the normal 20 business days, or look for the no action letter relief for investment grade debt securities where it's as little as 7 to 10 business days. So for example, maybe part of the strategy you're trying to do in connection with your tender offer or exchange offer is modify the terms of the target debt securities. Maybe you want to do an exit consent. Well, the abbreviated tender offer provisions are not going to be available. Maybe the dealer manager has determined that in order to get the best pricing for the issuer, it has to be structured such that there is an early settlement date and an early tender premium, okay? In which case, that's not going to be allowed under the early tender provisions because those features disqualify. It's one of the preconditions. So the old rules are still in effect and used quite frequently. That's the point of slide 39 here. Let's go to the next. Exchange offers. John, take it away.
Sure. And I will say, John, I think we are at time. So we'll have to go very quickly. If folks want to stay on, they can. But I remind folks we are going to put a recording of this on our website if people need to drop, and the materials will be available.
Maybe you'll get more CLE credit.
So exchange offers, right? Continuing along our continuum, right? The big difference here is that instead of paying cash to retire their debt, they're exchanging their debt for and issuing new debt, right? So obviously, what are this avoids a trip to the new issue markets, right? You don't have to issue a new security. You can instead exchange your security for one that's already outstanding. It can be a very attractive option, especially for an issuer that is short on cash, right? That is perhaps in distress, but needs to perhaps extend the maturity of its debt securities or make other changes without expending a lot of cash. Next slide, please. Here's a comparison between an exchange offer on the one hand and either a debt tender offer or a redemption plus a new issue on the other. The yellow bars delineate where a particular strategy has the advantage. So on the exchange offer side, right, there can be an accounting advantage, right? If you're exchanging debt that's at a premium, you can spread out the cost associated with that over the life of the new security. If you're doing an exchange offer and it satisfies certain tests, as opposed to having to take that charge straight away in a tender offer, refinancing scenario. There is, in a certain sense, no new execution risk. You don't need cash because you're just exchanging with your existing investors. On the other hand, where tender offer and a new financing does have advantages, is look, like if you're doing an exchange offer, you're really limited to the people you can offer the new debt to, right? You're only offering it to your existing debt holders, as opposed to a new offer where you can build a book and you can just do a price discovery and you can market the new debt security to a whole slew of potential new investors, including your existing investors. So that's why the tender offer refinancing can have some advantages. Obviously, there will be some cash that's involved, right? And maybe time it so that you receive the cash from the tender on the same day you do the new issue, but it could get dicey. Next slide, please. So typically, how do you do an exchange offer? As John was saying, right, we are issuing new securities. We need either an exemption or a registration statement. As a result, most debt exchange offers are done on a private basis using 4A2. Typically, that means that there is no general solicitation, right, as is the case with any 4A2, which means you're only marketing this to QIBs or to non-US persons on the basis of Reg S. And you're usually putting out a scoping letter where, before anybody can talk to the issuer about the exchange offer, they need to have filled out a QIB letter that basically says, look, I'm qualified. I'm able to accept these securities because I'm a QIB or I'm a non-US person. There is also the idea that, look, at the end of this, you're going to end up with restricted securities, and maybe you're not so, maybe you're worried about that. You want registration rights, or maybe you're not so worried about that because, the 144A debt markets are robust. And always remember that Rule 144 can be available. Next slide, please. Private exchange offers. I think we can, largely, just keep this slide high level. As you're putting out an offer. You're putting out an offering memorandum. It's not subject to SEC review. You are doing the pre-certification for QIBs, and after the offer period expires, which again must satisfy the 20 business day rule, unless you have an exception that we just talked about. You close the transaction. Next slide, please. 3A9 is another option that people use to avoid the registration requirements. It's a bit more onerous and it has some significant disadvantages, so it only can be relevant in certain circumstances. But basically, 3A9 says that securities issued, exchanged by an issuer with its existing security holders, where there's no commission or other remuneration paid for solicitation, can be exempt. There's 5 requirements to a 3A9. The securities have to be of the same issuer. That sounds simple, but maybe it's not. If you're adding guarantees or taking away guarantees, there's a no action letter line on that. You can't have any additional, consideration from security holders, so you can't get cash from them. In addition, if you're doing this, you're not raising new money. You're just getting the security back and issuing a new security. There's some exceptions for truing up of interest. Next slide. The exchange has to be exclusively with your own security holders. Again, that sounds simple, but you got to worry about integration. You can't be offering the same securities that you're issuing in the 3A9 in a different securities offering, because that could get integrated and below your exemption of 389. You can't pay a commission to an investment bank for helping you solicit in the tender offer, which can be very limiting, especially if the deal is complex and you need an investment bank to help explain it to the security holders. So 389 it has some significant limitations. Let's go to the next slide, please. Obviously, if you're doing a 389, if the securities on the front end were subject to transfer restrictions, the exchange securities are subject to the same ones, and vice versa. You can also be required if you are. You can also be required if the indenture that you're exchanging under has not been qualified under the Trust Indenture Act. 389 is not an exception from the Trust Indenture Act, unlike 482. So you have to watch out. Maybe you need a T3 filing. Something to be careful of. Next slide. Consent solicitation, John.
Consent solicitations. I'll try to bang this out in like 3 minutes. Okay. Once again, consent solicitations is simply soliciting the consent of the holders of your outstanding debt securities of a certain series to amend the terms of the indenture governing those securities. Okay. Now, unlike tender offers and exchange offers, which are subject to SEC rules and no action letters, consent solicitations are not. They're completely contractual. And to determine the type of the size of the consent you need is going to be set forth in the indenture or the agreement that governs the debt securities. Now, most amendments are going to require only a simple majority, but there are certain amendments which require the consent of a supermajority, which often has to do with releases of collateral. And there are some amendments which require 100% the consent from all of the debt holders. Those are generally the ones that relate to material pricing terms, like if you're reducing principal, changing currency, reducing interest rate, changing the maturity date. All of those are the type of amendments that are going to require all of the note holders to consent. Now, to get them to consent, you most often have to offer them a carrot, meaning the consent fee. And the different factors that come into what is going to be the size of the consent fee to offer are set forth in the circle here, which I won't go through all of them, but obviously the most obvious one is how material or immaterial is the amendment you're seeking. Is it going to have a material effect on the market value of the securities once those amendments go into effect? Okay. And there's a bunch of other things to consider in there. But the main thing is that the consent fee, it's not like the consent fee is set forth in the indenture. It is determined between the issuer and its advisor, the dealer manager, who try to come up with what would be acceptable to get the deal done. Now, it's very subjective. So what they generally do most often is they reach out to one or two or a handful of very large holders of the class of securities you're trying to amend. And they go to them and say, this is the amendment we want to do. What's it going to take? And when they get them on board and they have them sign an agreement, which they say, if you launch the consent solicitation, I will agree to consent. And generally in the consent solicitation statement that gets sent to all of the holders of the debt securities in connection with the consent solicitation, it'll state there on the cover saying, we have holders representing blank percent of the outstanding amount of the debt securities have already agreed that they will consent to the amendments. And that sends a signal to the other debt holders like, wow, they're already a significant percentage of the way there of what they need to get this effective. I might as well tender here, because if I don't tender and the amendment goes effective, I'm still subject to the amendments, but I didn't get the benefit of the consent fee. Next slide, please. So what are the benefits? I'm not going to spend too much time on it because they're obvious. The benefits are, increased covenant flexibility as a result of the amendments, allowing you to do transactions you otherwise couldn't do, like maybe a merger transaction, incurred debt, whatever it may be. Next slide, please. This slide has to do with the fact that there are certain terms, again, not only under the indenture or the debt agreement itself, but under the TIA, if the indenture is subject to the TIA, which will require the consent of all the outstanding holders. And there's one concept called the new security doctrine, which says if you're amending a security so much so that the security is actually almost a new security, I mean, it's so different from the one that preceded it, you want to be sure that your consent solicitation actually has a valid private placement or is registered with the SEC, because that's actually an offering of a new security. So you either want to make sure the transaction is registered or done pursuant to a valid exemption from the registration statement requirements. Next slide, please. Okay, so we talked about the carrot before, and John mentioned exit consents, so I'll just go through very briefly. Exit consents are simply where you are. It's if a carrot is not going to be enough to get what you want to achieve over the goal line, then you need a stick, and the stick is the exit consents. And way you do that is you have a consent solicitation, which is married to either a tender offer or an exchange offer. And in that offer, by tendering your securities to get cash, if it's a tender offer, or to get the new securities in the exchange offer, you are automatically deemed to have consented to the amendments to the indenture of the outstanding debt securities. And that amendment almost always strips every single restrictive covenant in that indenture. So if there are any securities outstanding after the amendment becomes effective, the debt securities have essentially zero covenant protection. Okay, so you don't want to be the last one that's stuck and not get the consent fee and stuck with an outstanding debt security that has no covenant package. So that's the stick to get people to enter into it. On the other hand, if you did go into the tender offer, you got the cash. If you got the exchange offer, then you got a new covenant package, which presumably is you're comfortable enough with, otherwise you wouldn't have tendered into the exchange offer, and is also sufficiently flexible for the company, otherwise they wouldn't have proposed it, and everyone's happy. And if you need additional resources, you can visit our website where we have our Structuring Liability Management Transactions publication. And by scanning the code on this page here, you can visit our blog, Free Writings and Perspectives, and Liability Management Resource page, which will give you a lot more information than we're able to cover in this short presentation. But sorry we went over, but we thank everybody for attending.